I mean, the big money is waking up to it, no question. And when I say big money, I think there's a duty when you have that kind of money to think. And I'll tell you that, and I mean, I'm serious about this. Where do you put your money at a certain point is very difficult, right? You got interest rates that on the short term, the very short term interest rates, which are coming down. I think you'll see the opposite on the 10-year. Will move the other direction, just like it did before, just like we see in London, where they've lowered rates 7 or 8 times, and yet their 30-year treasury is pretty darn well near its all-time high. The bond market controls the back end, but I wouldn't buy the back end anyway. I would own some 6-month treasuries or shorter duration, and those are coming down. Where do you put your money when inflation, the real level of inflation, is far greater than the interest that you're receiving for something as safe and liquid as a treasury? What happens if Trump gets his way and they lower rates 200 basis points to 2%? And the CPI, which is at 3.1% right now, is actually higher than the rate that is stated. Big money won't stand for that. We know that the CPI, because you've had John Williams on this show, will tell you it's 11% right now. Add an 8 to it, the way it used to be measured before they changed it. Point of it is where do you put your money? Stocks at all-time highs, bonds at not quite all-time highs, but losing demand rapidly. So much so you create something called the Genius Act, which it is kind of diabolically genius, to create synthetic demand for U.S. treasuries because the organic demand is waning. Where do you put it? You put it in real estate at all-time highs. You put it in banks that are over-leveraged and undercapitalized, where you are now a unsecured general creditor with bail-in laws. So yeah, I mean, I think there will come a moment where the public at large realizes this, but the big money is asking these questions every day. What do I do with all this money? And no one would have ever thought that having that kind of wealth would be such a pain in the ass, such a difficult thing to safeguard. And as you get older, you're more concerned about protecting than you are making, because, you're thinking of your children and your grandchildren, and how do I pass it on appropriately. Interest rates spike in an environment where there's that black swan. Well, the banks are in trouble, the insurance companies are in trouble, the bond market's in trouble, the stock market's in trouble, real estate's in trouble. Where do you go? And I think people are realizing this, and it's kind of a softball question for a guy that owns a precious metals company, but if people haven't figured out by now that I try to be as genuine as humanly possible, that I do as I say, they never will believe me. I will just simply say, to me, there are very few places where I think you can safely keep your money with a high degree of liquidity, where the biggest money in the world is showing you through their actions where they're going. And I think you will see that public catch on. But typically, the big money, well, they do this in the cover of darkness, where you got guys like, Jim Cramer, moron, saying, it's too speculative, it's frothy. They're not looking at this the right way, and they're not really part of it. But there are a lot of people who are clued in and understand where we're going and what's happening, that are buying gold and silver as a life raft. And that's the way that I look at it, but not just for an emergency, right? It's for an opportunity as well. And maybe having that dry powder in the form of something that is keeping its purchasing power against a dollar that's down 11% this year and gold up over 40, it's keeping its purchase. You go back as far as you want, and I can make this analogy in real estate and in anything. Gold maintains its purchasing power, and most other items across the board, from food to energy to real estate, measured in gold, it's becoming cheaper and cheaper and cheaper as things measured in dollars are becoming more and more and more and more expensive. You can pick anything you want. Automobiles, college tuition, and I have an answer for it. And that's the scary thing. I wrote one thing down to kind of show that it just kind of caught my attention. And it's just very simple. In 1978, a student working full-time summer job at the minimum wage of $2.65 an hour could earn roughly $1,378, which was more than enough to cover the average tuition and fees of $688 at a public university. So when you talk about inflation outpacing standard of living, it's extraordinary. But if you look at gold at its value, since then, since 1978, when it would have been priced at, I don't know what it was back then, a few $100s anyway. But point of it is that, look at where gold is today from where it was then. In fact, let's just look real quick just to make the point. We'll see where gold was in 1978. What was average gold price in 78? Was $193.4. So if you are earning minimum wage and you're able to make, what did they say, 1,378. So 1,378 divided by 193.4. Well, you would have bought 7 ounces of gold with your minimum wage summer job that today would be worth $26,000. So that would cover your tuition in most public schools. A lot of the highfalutin ones are going to be 3 times that, because college is probably a poor example showing how much it's outpaced itself. But point of it is that what is $1,100 worth in fiat versus in this term. I just think it's important to understand that gold and silver have done a wonderful job in the face of a dollar that is destined to continue to lose purchasing power and probably accelerate.
People often ask me, Andy, what's the big money doing? Are they buying gold? Are they waiting? And I always laugh a little before I answer, because by the time the public is asking that question, the big money has already acted. They don't announce their moves on CNBC or in the Wall Street Journal. They do it quietly in the shadows when the market's asleep and no one's paying attention. Then, 6 months later, everyone else wonders why there's no supply left and premiums have doubled. That's what's happening again. The big money is waking up. Not the retail investor who watches Jim Cramer say, buy the dip. I'm talking about the kind of money that has the ability to move entire markets. Family offices, sovereign wealth funds, hedge funds, and pension funds. The people who have the kind of wealth that forces them to think differently. You see, there's this misconception that having wealth makes everything easy. It doesn't. It makes everything harder. When you're talking about hundreds of millions or billions of dollars, you can't just park that in a savings account and call it a day. The world's not safe anymore for that kind of lazy thinking. Bonds are no longer the safe haven they once were. Stocks are at historic valuations. Real estate is bloated, illiquid, and dependent on artificially low rates that are gone. Banks? Forget about it. Between over-leveraging and bail-in laws, depositors have quietly become unsecured creditors. So, where do you put your money? That's the question every serious money manager is asking right now. And for once, the answer is surprisingly simple. You put it where the central banks are putting theirs. That's right. The same institutions that printed oceans of fiat currency are now hoarding gold. Why? Because they know exactly what they've done. The people creating the problem are quietly buying the solution, and it's not just central banks. It's the biggest private institutions in the world. When the chief investment officer of Morgan Stanley abandons the sacred 60-40 portfolio, 60% stocks, 40% bonds, and moves to a 60-20-20 model with 20% allocated to gold, that's not noise. That's a tectonic shift. When Michael Hartnett from Bank of America releases a report suggesting investors move to a 25-25-25-25 model, 25% stocks, 25% bonds, 25% T-bills, 25% gold, you know we're entering a new era. This isn't prepper talk. These are the most mainstream legacy institutions in the world, quietly admitting that something is broken. Let me remind you, for the last 40 years, if you even suggested holding more than 5% of your portfolio in gold, you were treated like a conspiracy theorist. You were the crazy uncle at Thanksgiving. Well, now those same institutions are saying, maybe 20% gold isn't such a bad idea. What changed? The trust is gone. When a 10-year treasury guarantees you a real loss of purchasing power, it's not an investment anymore. It's a slow-motion theft. Inflation isn't 3%. It's not even 5%. John Williams' Shadow Stats, which calculates inflation the old-fashioned way, says it's closer to 11%. So if your 10-year bond yields 4.5%, you're locking in a 6.5% loss every year. That's not an investment. That's a punishment for being responsible. The government doesn't have buyers for its debt anymore. That's why they invented what I call the Genius Act. It's a synthetic way to create demand for treasuries when real demand has evaporated. It's diabolically clever. But it's also desperate. When the market has to be manipulated just to sustain itself, you know the end game is approaching. So again, where do you put your money? If you're sitting on billions, you start looking at the only assets that don't carry counterparty risk. That's gold and silver. That's land, productive resources, and in some cases, energy infrastructure. But let's be real. Gold and silver are the easiest to liquidate, transport, and store. They're not just assets, they're freedom instruments. And it's not just about safety anymore, it's about opportunity. Because while the mainstream calls it insurance, those of us who've been around long enough know that in times like these, insurance becomes wealth.
If you're speaking about change in the interest rate environment, I don't know, I find it very interesting that we see the chief investment officer for Morgan Stanley shift from a 60-40 allocation to a 60-20-20, 60% stock, 20% bond, 20% precious metals. Michael Hartnett, the chief investment officer for one of the investment, or I think he's chief, for Bank of America, just came out with a 25-25-25-25% strategy. Again, you're seeing big money advisors, money managers, or investment officers reallocate their clients' portfolios away from a 40% allocation to U.S. Treasuries. They are pivoting into what would have been unimaginable. As Rick has often said, and I borrowed that statement from him for so long, 0.5% from Joe and Jane Sixpack to the Harvard Endowment Fund. And I caught the last part before I jumped on here where the Harvard Endowment Fund actually did buy some gold and silver. But we're getting to see, I think, the money managers or the investment officers from these large institutions pivot the way that the central banks seem to have been doing now for at least a year or two, where they have been shedding U.S. Treasuries in favor of gold, which not only has outperformed the U.S. Treasury market, in fact, it's doubled the performance of the 10-year Treasury over the last 25 years. But look at last year, where gold was up north of 40% and the U.S. Treasury 4.5%, or this year, where you have the U.S. Treasury three-quarters of the way through the year, call it up 3%, yet the dollar's down 11% and gold is up nearly 50%. So we are witnessing a pivot away from traditional forms of investment, traditional ideology, into something that we have been talking about that was fringe. And you never heard money managers talk about anything greater than a 5% allocation to precious metals. Now, we always knew that was underweighted, certainly, but to see the CIO from some of the biggest commercial banks on the planet start to do this tells you that we are moving towards some form of a new understanding, appreciation, or integration of gold and silver into people's portfolios. And quite frankly, if they would have been listening to guys like Alistair or Rick a long time ago, these moves would have been made years ago when there was still a tremendous amount of upside to be made. Now, not to say there isn't now, but how much of the move has been missed, I guess only time will tell. Actually, I don't think that it's been too much in comparison to where I think it is going. But I think the most important thing to take away from this is that you're seeing some of the biggest and influential institutions here in the United States rethink their investment ideology. It's an interesting time, and I hope the general public catches on before it's too late, because I can tell you on the retail side of things, we've seen very sophisticated big money jump in with both feet over the last month or so. Business has been extraordinary. It hasn't been what it was like in 2021, January, February, silver squeeze, where we were getting 500 orders a day. Now we're getting more like maybe 100 or 150, but the size is much greater. The understanding is much greater. The mainstream, they haven't really woken up yet, but there is a subset of people probably listening to Rick and Alistair and you, Dunnigan, who are waking up. And hopefully it's not too late for the rest of the public. Certainly, I think this is a change that is long overdue and one that I welcome very much. Well, I think the biggest The biggest indictment against the system is, well, there are a couple. Number one would be the cross-border payment system, the renminbi cross-border payment system that was the M-Bridge. And this system, which is operational, has already been connected to 11 countries in Southeast Asia, which in and of themselves have twice the population of the United States, about 800 million people, and they also have taken over as China's largest trading partner by far.
When I left off, I said that it's not too late, but it's getting close. And I mean that sincerely, because what's happening now isn't some blip in the data. It's not a short-term rally or a speculative mania. It's a paradigm shift, a slow, grinding, global awakening to the realization that the financial system we've lived under for the last 50 years is fundamentally broken. You see, for decades, the Western world has run on a trust-based system. Trust the government, trust the banks, trust the Federal Reserve, trust the paper. And that trust held as long as the illusion of stability did. But the illusion is fading fast, and what's taking its place isn't chaos, it's recalibration. That recalibration starts with gold. I know it sounds cliche, but gold has always been the world's default setting. When everything else fails, humanity goes back to what it can weigh, hold, and measure. It's not sentiment, it's arithmetic. And right now, that arithmetic is turning against the US dollar. Let's talk about what's really going on with the so-called de-dollarization that people like to dismiss as overhyped. The truth is, it's not some grand, coordinated PR stunt from China or Russia. It's a survival instinct from nations that are tired of being held hostage by a system they no longer trust. Take the M-Bridge platform. It's already operational. This is the digital cross-border settlement system that allows countries to bypass SWIFT entirely. It's not a prototype anymore. It's working. 11 countries in Southeast Asia are already connected, representing roughly 800 million people. That's twice the population of the United States. And they're settling trade in local currencies, and soon in gold. That's not conjecture. That's on the record. The first major vault under this system is already complete, in Hong Kong. The Shanghai Metals Exchange oversees it. That means that for the first time, a nation or company trading in digital yuan can instantly convert that transaction into gold without touching the US dollar. That's monumental. And it doesn't stop there. The second vault is being built right now in Saudi Arabia. Think about that. The birthplace of the petrodollar is now building a gold settlement vault under the same infrastructure that's meant to replace the petrodollar system. This is what I mean when I say we're witnessing a new world emerge in real time. If you still think the dollar's supremacy is guaranteed, you're living in 1995. The dollar's share of global reserves has dropped from over 70% 2 decades ago to under 58% today, and falling fast. That's not a conspiracy theory, that's IMF data. And behind the scenes, the BRICS nations, Brazil, Russia, India, China, South Africa, and now over a dozen others applying for membership, are laying the groundwork for a gold-backed settlement mechanism. It's not about creating a single BRICS currency. It's about creating options. Options that bypass Washington, options that don't require exposure to US sanctions or weaponized finance, options that are anchored to something real. I said it before, and I'll say it again. You don't have to like it, but you'd be foolish to ignore it. Now here's the funny part. The same analysts who laughed at the idea of BRICS cooperation 5 years ago are now scrambling to model what a gold settlement system could mean for global liquidity. I read a thread the other day from an economist on X, formerly Twitter, who wrote, "Gold settlement is the only realistic path for de-dollarization that doesn't end in chaos." Exactly. It's the adult version of the conversation everyone's been afraid to have. Meanwhile, back home, what's the US response? Print more, borrow more, deny more. We're spending money as though deficits don't matter, even though the cost of servicing our debt now surpasses military spending. That's the kind of math that ends empires. It's not politics, it's history. Every empire in the last 1,000 years has collapsed under the same weight: debt, devaluation, and denial. So when I see big money pivoting toward gold and silver, when I see Harvard's endowment buying bullion, when I see Morgan Stanley and Bank of America reweighting portfolios, when I see central banks adding at the fastest pace since 1967, I know exactly what's happening. The lifeboats are being lowered, and most people are still on deck listening to the band play. But let me say this, it's not all doom and gloom, because for those who understand what's happening, this is also one of the greatest wealth transfer opportunities of our lifetimes. You see, the people who have gold and silver when this system breaks won't just be safe, they'll be positioned. Because when fiat systems reset, hard assets don't just preserve wealth, they reprice it. Let's put this in perspective. If global institutions merely shifted from their current 0.5% gold allocation to, say, 10%, that would represent a 20-fold increase in demand. There isn't enough above-ground gold to meet that without the price going to the moon. Now imagine they followed Bank of America's model and went to 25%. That's a 40-fold increase. There isn't a refinery, a mint, or a vault on the planet that could meet that kind of demand. That's not hyperbole. That's logistics. When demand spikes in a market this small, price discovery gets violent. And I believe we're on the doorstep of that phase. Look at the data. Premiums are rising, supply chains are tightening, and delivery delays are starting again. Dealers who used to sit on months of inventory are now running lean because the cost of carrying product has exploded. Insurance, shipping, and financing are all more expensive. So when demand returns, and it's returning now, the supply response lags by months. That's how you get a market that goes from calm to chaos overnight. And I'm telling you, we're closer to that than most people realize.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.